Welcome to the deep dive. Today, we're cutting through the silence around one of the biggest financial stories, really developing right now. Imagine an asset hitting an all-time high, a record-breaking moment, and yet it's strangely quiet, almost eerily so. No blaring headlines, no mainstream fanfare. That's exactly what's been happening with gold recently.
And that silence actually, it tells us almost as much as the event itself, doesn't it? This isn't just, gold prices climbing. It's a powerful indicator of much larger systemic global financial shift.
The big shift.
A really big one. We're looking at what some are now referring to as a monetary system reset, maybe a once-in-50-year rotation of asset classes that, well, few are openly discussing.
Okay, so our mission today is really to uncover the truth behind this great unspoken, as you put it. You've given us a stack of sources, and we'll be diving deep into them to understand why this is happening, what it means for the value of our currencies, the stability of traditional investments, and critically, how sophisticated players are already moving, to navigate these turbulent waters. Prepare for some truly insightful moments, I think. So let's start right there. Gold recently recorded an all-time nominal high. It vaulted from, $1,700 to $3,500 an ounce in just the last 3 years?
That's right.
That's an incredible surge, yet, like we said, it's barely registered in much of the mainstream financial press. Why the disconnect?
It's a crucial question, yeah. And this isn't merely a normal bull market for gold. That's key. What we're witnessing is primarily a reflection of currencies everywhere. And yes, that definitely includes the dollar depreciating against gold.
Oh.
Gold is acting as the ultimate barometer here, signaling a fundamental reshuffling of the deck in the global financial system. It's not so much gold getting stronger, but maybe everything else getting weaker.
That's a stark way to put it. If gold's rise reflects the weakness of other currencies, what does this tell us about the dollar's standing, on the global stage right now?
This is where the bigger picture really comes into view, and it's quite something. For the first time, foreign governments and central banks now collectively hold more gold than they do U.S. treasuries.
Wow, more gold than treasuries.
Exactly. Think about that for a moment. This indicates a profound trust deficit in the dollar and, by extension, in U.S. debt. It's a foundational shift, really, in how global institutions perceive financial security.
And when we look at the numbers, maybe it's not hard to understand why they feel that way. The U.S. Treasury projects national debt to go well north of $22 to $25 trillion in the coming years. That's a staggering level.
It is.
And that level of debt means an almost certain reliance on money printing to pay it back, which, as we know, invariably erodes the dollar's value.
Absolutely. Foreign holders naturally aren't keen on holding increasingly inflated dollars, are they? So they're shifting into gold. Why?
Well, for its inherent credibility, its recognized liquidity, and, importantly, its physical security. It's a very rational, practical move from their perspective.
Makes sense.
And the momentum for this shift, it's building. You can see it. We see global leaders like Putin, Xi, and Modi openly advocating for trade in local currencies, actively laying the groundwork for a world far less dependent on the dollar.
So this isn't just talk.
No, this isn't just rhetoric. It's a sober reality that confidence in the dollar is slipping. Other nations aren't just contemplating alternatives, they're actively pursuing them.
And if this trend continues, the financial impact could be immense. I saw Goldman Sachs suggest that if just 1% of the money currently held in U.S. treasuries pulls out and moves into gold, gold could hit $5,000 an ounce. Right. And Bald Guy Money, another analyst, they estimated a staggering $9,000 gold if 20% of that capital shifts.
9,000.
Yeah. These aren't minor predictions. They point to a potentially seismic revaluation.
Now, despite these figures, and this is interesting, mainstream financial advice, from organizations like the Florida Association Managers for Retirement Communities, often cautions against gold. They dismiss it as a volatile and speculative asset that does not pay a dividend. For many, this has been conventional wisdom for decades.
And this brings up a critical question.
Yeah.
Is that really the full story, particularly when we zoom out a bit? If you had bought assets the day President Nixon closed the gold window, that pivotal moment, August 15th, 1971.
Right, when the dollar lost its gold backing.
Exactly. Gold was actually the best performing asset over the past 54 years. It outpaced both the S&P 500 and the Dow Jones, even when you account for reinvested dividends.
Even with dividends.
Even with dividends. And silver, interestingly, came in just behind them. That long-term performance completely reframes the no-yield argument, doesn't it?
It absolutely does. And to take that idea a step further, David Morgan's analysis, when he prices the Dow Jones Industrial Average in gold, It shows that the stock market has essentially been in a bear market since 2000. Measured against gold, things look cheaper.
It completely reshapes our understanding of value in the market, you could say.
Yeah. This quiet revolution in gold's standing, it brings us directly to a crucial player, the Federal Reserve. We have insights from former U.S. Treasury official Scott Bent's January 2024 letter. He sharply criticizes what he calls inappropriately easy monetary policy for inflating our current equity bubble. He's even advocating for a comprehensive, independent review of the Fed. What are the key points he's making there, and how might that impact, well, everything?
Well, Bent's call for review is highly significant. He asserts that the Fed has strayed beyond its mandate and really needs to rebuild credibility. His view is they should relinquish banking supervision and limit economic intervention outside of crises. And this critique isn't isolated. It directly aligns with political efforts we're seeing. Like President Trump's past signals to appoint officials who might attempt to sever the independence of the Fed. The integrity and independence of this institution are very much in play.
And there are serious warnings attached to that prospect, aren't there? Goldman Sachs, for example, has cautioned that political control over the Fed could severely harm its credibility. They say it could lead to increased inflation and undermine trust, which are precisely the conditions that could push gold towards that $5,000 mark we mentioned.
It's almost as if they were anticipating the current trajectory. And adding another layer to this, Dr. Judy Shelton. She was a financial advisor to Trump. She noted the Fed explicitly discussed abandoning its duty to maintain stable prices, which, historically meant 0% inflation.
Right, zero.
They redefined it as a stable rate of change, targeting 2%, and are now openly admitting it will be more than that for a long period of time.
Which sounds like...
Well, as Dr. Shelton pointed out, it's basically an admission of exponential decay in the purchasing power of the dollar. They are, in essence, openly acknowledging the erosion of your dollar's value.
So, with these forces at play, how do physical precious metal movements reflect this changing landscape? And what about these concerns over potential market manipulation?
Well, the activity in the physical market is definitely telling. We're seeing billions of dollars worth of gold and silver being delivered into Comex. That's the main futures exchange every single month.
Billions a month.
Yeah. In just the first few days of one recent September contract, we saw $1.35 billion worth of gold and an even larger $2.22 billion worth of silver physically delivered.
That's a staggering amount of physical metal changing hands.
It truly is. Now, while not all of this metal is necessarily leaving Comex to go into private vaults, there's a clear trend of significant hoarding. And this also raises concerns about how prices might be, well, artificially held down, particularly through instruments like GLD and SLV, those popular ETFs.
Right, the ETFs.
Ed Steer, a longtime observer, he goes as far as to describe the short position in SLV, which is managed by BlackRock and JP Morgan, as fraudulent beyond deception. He points out that the physical silver required by SLV's own prospectus simply isn't there to back it, which is a pretty strong claim.
That's a very strong claim. And Rick Rule, another prominent voice, confirms that hoards of physical silver are in fact growing in vaults around the world. Even BlackRock's own prospectus for SLV apparently warns short sellers of a potential future where there might not be enough silver to cover positions.
Exactly, leading to a potential short squeeze and sending prices parabolically higher. They acknowledge the risk themselves, right there in the fine print.
So they know it could happen.
Precisely. And when we compare the current gold price of, say, $300, $640 an ounce, silver appears dramatically undervalued, just based on historical ratios and even geological ones.
How undervalued?
Well, for example, based on a 70.1 gold to silver ratio, silver could be $52 an ounce. At the historical average of 45.1, it's $91 an ounce. And the geological ratio, which is about 7.1, that suggests silver could be $520 an ounce.
Wow, $520.
Yeah. Even if gold only hits $5,000 an ounce, a high 90.1 ratio puts silver at $55 an ounce, while a more typical 70.1 ratio implies $350. The point is, silver is widely seen as heading significantly higher. It suggests its current price might be heavily suppressed.
These insights into precious metals are compelling. But how do these specific market dynamics connect to the broader shifts we're witnessing in global bond markets?
Well, we're seeing a very clear and frankly concerning pattern emerge globally. Take the UK, for instance. Their 30-year bonds recently surged above 5.7% for the first time since 1998. And this happened despite the Bank of England cutting rates 5 times this year.
Cutting rates 5 times, but yields still went up.
Exactly. This isn't just an anomaly. It signifies the market's outright rejection of those rate cuts. Why? because of persistent deficit spending and inflation. It really shows that central banks are struggling to maintain control, and the market is pushing back hard.
That's a stark example.
Right.
Does this kind of market rebellion suggest a similar future for the U.S. bond market? I mean, the U.S. has issued over $200 billion in bonds in just 5 weeks. We're reaching a point where investors are becoming noticeably reluctant to buy at current yields. On top of that, a weakening labor market alongside rising inflation. You mentioned the U.S. unemployment rate for 16 to 24-year-olds is at 10%. It increasingly points towards...
Well, stagflation.
That's a very real concern.
Right.
Stagflation looks increasingly likely. And to underline this point about shifting assets, for the first time since 1996, central bank gold holdings globally have surpassed their holdings of U.S. treasuries.
I mentioned that earlier, yeah.
Yeah.
Monumental shift. It is. And it's not just the big players. We even saw El Salvador Central Bank recently buying 14,000 troy ounces of gold for $50 million. Their first gold purchase in 30 years, and notably, they used proceeds from their Bitcoin reserves to do it. These aren't isolated events. They're all pieces of a larger puzzle.
Speaking of the labor market, let's dig a little deeper into that. Looking at a recent August jobs report, the Bureau of Labor Statistics reported only 22,000 jobs added. That was far below the 79,000 expected.
Way below, yeah.
And even more tellingly, June's figure was revised from an initial 27,000 gain down to a negative 13,000. That's the first negative print since 2020. What's the real story behind these numbers?
The revisions are certainly striking, yeah. But maybe the most concerning part of that report is the composition of the job losses and gains. For the second consecutive month, 357,000 full-time jobs were lost, gone, while part-time jobs surged by 597,000.
So fewer full-time, way more part-time.
Exactly. This isn't really a sign of robust employment. It suggests a growing number of people are working, 2 or 3 jobs just to make ends meet. That's not strength.
And the details get even more granular, right? Native-born workers fell by 561,000, while foreign-born workers actually increased by 50,000.
Correct.
Plus, the number of multiple job holders soared by over 443,000, the biggest monthly increase since COVID. These numbers painted a very different picture than the initial headline suggested.
And we anticipate even more revisions coming. Upcoming figures for job growth from early 2024 through early 2025. They're expected to remove between 475,000 and maybe even 1 million jobs from the originally reported 1.76 million.
A million jobs potentially revised away.
Potentially. So the picture of economic strength might be significantly weaker than previously understood.
So if we look beyond the official statistics, what does this actually mean when we talk about the actual economic strength of the U.S.? It seems less strong than advertised. Beyond the domestic economic picture, we're seeing some really striking geopolitical realignments happening too. Former President Trump recently stated that the U.S. has lost India and Russia to China and wished them a long and prosperous future together. That's quite an acknowledgement.
It is. Those comments highlight a significant geopolitical shift that's been underway for some time now. Both India and China have openly confirmed boosting their ties, specifically to reduce the effect of U.S. tariffs. It's a direct response. And Indian Prime Minister Modi, on several occasions, has called out Western nations for what he views as selfish decisions, while urging stronger relations between Asian neighbors. It's a clear move towards a more multipolar world, challenging those established alliances.
And this isn't just talk either, is it? The Shanghai Cooperation Organization, the SKO, they've decided to establish a development bank and accelerate consultations on its operations. This new bank will apparently be connected hand-in-hand with the BRICS new development bank.
Right. They share the same goals, many of the same participants. It looks like they are moving towards a merger, essentially. This consolidation of financial power outside the traditional Western system is a massive development. Don't underestimate it.
Definitely seems significant.
And consider India's position. They actually have more to lose economically by ending their purchase of Russian oil than they do by stopping trade with the United States. U.S. trade currently amounts to less than 2% of India's GDP. That really puts their priorities and allegiances in a very different light, doesn't it?
It does. It underscores the reality of a rapidly evolving global economic architecture.
And the speed of these shifts away from traditional alliances is, well, it's striking. And this brings us to another critical area of vulnerability. The banking system itself. We're certainly not out of the woods yet with the banks, not by a long shot. We're still seeing insured deposits shrinking, especially leaving regional and smaller banks. The instability we saw glimpses of It isn't over.
And a lot of that money is finding competition, right? With digital banks and stablecoins, they offer higher yields, lower fees, instant transfers, mainly because they lack the massive overhead of all those brick-and-mortar branches.
Exactly.
This phenomenon is set to massively erode the stickiness of bank deposits, which historically has been the very foundation of bank stability. It's a powerful disruptive force.
It really is. And think about this. If the Fed eventually cuts rates, banks will earn less from lending, but they'll still need to pay competitive deposit rates to keep customers from fleeing to digital options.
Squeezing their margins.
Dramatically. This makes weaker regional banks even more vulnerable. Think of a Bank of Lindsay, Oklahoma scenario like we saw with some collapses last year. The system is under immense, multifaceted pressure.
And the fallout could be severe if another major institution cracks. We might see an even greater concentration of money moving into the too-big-to-fail banks, and maybe a handful of fintech institutions, which will mostly be one-to-one backed by U.S. dollars and treasuries, further centralizing financial power.
That seems like a likely outcome, yeah.
So, okay, with all these distortions and vulnerabilities swirling around, where are large, sophisticated investors, the so-called smart money, putting their wealth? Because the old bag of tricks, treasuries, stocks, real estate, they seem problematic, to say the least, based on everything we've discussed.
It's true. The old bag of tricks really doesn't seem to work in this environment. Real negative interest rates make traditional bonds a no-starter if you want to preserve purchasing power.
Right. You lose money just holding them.
Yeah, pretty much. The equity market, as we discussed, has valuations higher than the 1929 crash peak, accompanied by the largest ever margin debt and options exposure by the public. While insiders are literally moving the other direction they're selling, the smart money is clearly seeing very different signals than the average retail investor.
And real estate. You mentioned earlier it's a monster bubble created by 30 years of suppressed interest rates.
Yep. And it's further distorted by municipalities artificially pumping up assessed home values to try and hide their own exponential runaway debting.
That sounds precarious.
It is. We're looking at an estimate that maybe 36% of homeowners can't even afford their municipal debt, or their home valuations simply don't support it. It mirrors the risks we saw back in 2008, where potentially a third or more could lose their property if things unravel.
So if bonds, stocks, and real estate all look shaky.
Given all this, gold and silver offer a unique appeal right now, not necessarily as investments to get rich quick, but because they are wealth. They are simply a store of value, historically proven, and the biggest money in the world. Central banks, global lenders, major corporations, the ultra-wealthy, they've been quietly repositioning. They've been front-running what could genuinely be a bull market of a lifetime for precious metals. They are not waiting for the mainstream headlines to tell them what to do. They already see it.
The numbers certainly speak to that, don't they? Gold is up 40% in the last 8 months, while the dollar is down 11% against it. When you look at those figures side by side, it really highlights that maybe keeping your money in dollars is the worst thing to do in this specific environment.
Well, the question of how high can gold go effectively becomes how low can the dollar go? And historically, all fiat currencies, by their very nature, their design, they are eventually meant to die. Their purchasing power erodes over time.
Always happens eventually.
Always. Now, we're not suggesting infinity for gold, of course, but it illustrates the sheer potential for revaluation against failing currencies. The historical suppression of interest rates also suppressed gold's price, creating an illusion of stability that is now being called out and acted upon by sophisticated investors worldwide.
Okay, we've definitely unpacked a lot today. It's clear that multiple powerful forces are converging here. We've got dollar devaluation, a potential loss of Federal Reserve independence, the prospect of ongoing lower interest rates, and this massive capital rotation away from traditional assets and seemingly into precious metals.
And these are not isolated events. That's the key takeaway. They are interconnected pieces of a rapidly shifting global financial landscape. What's crucial for you, the listener, to consider is this fundamental reality. The wealthy don't keep their significant money in cash. They generally don't. They own assets. Why? Because they intimately understand the inevitable destruction of purchasing power inherent in fiat currencies over the long term.
So, what does this all mean for you listening right now?
As our mutual acquaintance, Alistair MacLeod, often reminds us, it's almost always the people inside a country who are the last to wake up to the destruction of their own local currency. It's kind of ironic.
It is. Foreigners typically figure it out first and position themselves accordingly. They see it from the outside.
Right. So the question then becomes, Are you positioning yourself as an early mover, looking at these trends? Or are you risking being caught unprepared, maybe even becoming a victim of these profound, unspoken shifts happening right under our noses? Something to think about.